Ever wondered how macroeconomic factors influence the stock market? Today, we're going to decode this complex relationship. Macroeconomics, in the study of the behavior of the economy as a whole, play a significant role in shaping the stock market. There is aspects such as inflation, interest rates, gross domestic product or GDP, unemployment, and corporate earnings. Each of these can dramatically sway the stock market, affecting your investments. For instance, high inflation can erode the value of your returns, while an increase in GDP can boost stock prices. The interplay between these factors is intricate and often unpredictable, adding to the thrill and challenge of investing. Understanding these dynamics is crucial for investors, as it can guide decision-making and strategy. It's not just about picking the right stocks, it's also about understanding the bigger economic picture. So, let's dive into the world of macroeconomics. First, let's tackle inflation. It's not just a buzzword, it has real implications for your investments. Inflation is a phenomenon that erodes the purchasing power of money over time. Picture this: if a candy bar costs $1 today, with a high inflation rate, the same candy bar could cost you $1.10 next year. This erosion of purchasing power doesn't just affect your candy bar purchases. It has a direct impact on the real returns of your investments. When inflation is high, the real value of returns decreases. This leads investors to demand higher returns to compensate for the lost value, which can result in lower stock prices. But it's not all doom and gloom. Some stocks, particularly those in sectors that can pass on higher costs to the consumers, may actually perform well during inflationary periods. Remember, inflation can be a double-edged sword in the stock market, so keep an eye on those inflation rates. Next up, interest rates. Ever noticed how the market reacts to interest rate changes? Interest rates play a crucial role in the ebb and flow of the stock market, creating an interesting dance between stocks and bonds. You see, interest rates and stock prices share an inverse relationship. That is, when interest rates go up, stock prices often go down. But why does this happen? Well, when interest rates rise, the fixed returns that bonds offer suddenly become more attractive. This can cause investors to divert their attention and capital away from stocks and towards bonds. As this shift occurs, stock prices can experience a decline, impacting the overall performance of the stock market. So the next time you see a headline about interest rate changes, remember this inverse relationship. It's not just numbers and percentages, it's a signal that could potentially influence your investment decisions. The key takeaway: interest rates matter a lot. Now let's talk about GDP growth, unemployment, and corporate earnings. Three big players in the stock market game. Gross domestic product, or GDP, is a measure of a country's economic performance. It's like the heartbeat of the economy. When GDP growth is robust, it's a sign that the economy is healthy and vibrant, and companies tend to see an uptick in revenues and profits. This positive outlook can lead investors to buy more stocks, pushing stock prices higher. In other words, a thriving economy often equates to a thriving stock market. On the flip side, we have unemployment. Unemployment rates are like the temperature of the economy. High unemployment rates can put a chill on the stock market. Why? Well, when lots of people are out of work, consumer spending tends to decrease. This decline in spending can eat into corporate profits, leading to a drop in stock prices. Conversely, low unemployment rates can heat things up. More people with jobs often means more consumer spending, which can boost corporate profits and in turn, lift the stock market. Lastly, let's look at corporate earnings, the lifeblood of any company. The financial health of a company, as reflected in its earnings reports, can directly affect its stock price. Positive earnings reports can be like a shot of adrenaline, driving stock prices up. On the other hand, negative earnings reports can send stocks into a nosedive. Investors pay close attention to these reports as they provide a snapshot of a company's financial health and future prospects. In summary, GDP growth, unemployment, and corporate earnings are like the pulse, temperature, and blood pressure of the economy. They're vital signs that can tell us a lot about the health of the stock market. These three factors are essential indicators of economic health and stock market performance. Keep them on your radar. So we've unpacked some heavy concepts today. Let's quickly summarize what we've learned. Macroeconomic factors play a significant role in influencing the stock market. Inflation, for instance, erodes the purchasing power of money. When it's high, real returns on investments decrease, prompting investors to demand higher returns. This leads to a drop in stock prices. However, certain sectors that can transfer these increased costs to consumers may fare better during inflationary periods. Interest rates and stock prices share an inverse relationship. As interest rates rise, bonds become more appealing due to their higher fixed returns. This can cause investors to shift away from stocks, leading to a decline in stock prices and overall stock market performance. Economic growth is a positive driver for stock markets. When the economy grows, as measured by gross domestic product or GDP, companies see higher revenues and profits, which can drive stock prices higher. Unemployment is another key factor. High unemployment rates can impact consumer spending and corporate profits negatively. On the flip side, low unemployment rates can boost consumer confidence, leading to increased spending and stock market gains. Lastly, the financial health of companies, reflected in their earnings reports, directly affects stock prices. When earnings reports are positive, stock prices often rise. Conversely, negative reports can cause declines. These factors interact and influence each other, creating complex dynamics in the stock market. It's crucial to keep a close eye on these factors and understand their interplay to make informed investment decisions. If you found this video informative, please like and subscribe. Your support means the world to me and will enable me to improve the quality of these videos. Leave a comment with any video suggestions you might have, and remember, keep investing smartly.